Well, those of you who have joined us from the Central Time Zone in all points west, good morning. This is Scott Bussey with Baring Financial Advisors. I want to welcome you to our webinar today called The Living Portfolio, a Logical Approach to Containing Your Investment Risk. Again, my name is Scott Bussey. I've been with Baring Financial Advisors since 2002. I entered the business originally in 1980 with Merrill Lynch Capital Markets. In 1983, I helped them establish a whole loan trading desk in New York City. I moved in 1987 to Bear Stearns to focus on merger and acquisition transactions for financial institutions. Our group moved from Bear Stearns to Donaldson Lufkin Jenrette in 1990. We broadened our scope of business and increased the amount of business we did in the M&A world for banks, thrifts, all kinds of credit and finance companies. And in 1998, when Credit Suisse bought Donaldson Lufkin Jenrette, I joined EQ Financial Consultants here in Austin, Texas. I became a regional vice president, then manager of their corporate financial planning division. A little bit about the company. Baring Financial Advisors was founded in 2002, serving both an institutional as well as a retail client base. We did the classic financial planning business practice as well as contract due diligence and corporate consulting for our institutional clients. We evolved towards tactical money management, eventually focusing only on the private client sector. We also began the study of investment risk and management of that risk back in 2007. Today we specialize in factor-driven equity-based investment models. We manage 8 different equity-based models as well as tactical portfolios across 5 other major asset classes, including currencies, commodities, fixed income, equities, both U.S. and international, as well as alternative investment classes. We do consider ourselves specialists in the area of investment risk management. Now, before we go any further in this process, I'd like to provide a short disclaimer that securities and advisory services offered through us or offered through VSR Financial Services, Inc., a registered investment advisor and member of FINRA and SIPC, SIPC. Baring Financial Advisors is not owned or controlled by VSR Financial Services. Some housekeeping issues to take care of. If there's an interruption in the transmission of this webinar to your computer, just click on the browser's refresher button. That's the circular arrow up in the URL box, shows the address at which you're zeroing in on this transmission. It should pick you up right back where it left off. I can't control the technology or the bandwidth, but just want to tell you that that is the case. Just click on the refresher button and you shouldn't have any problem. This is geared to be about a 30-minute presentation, not counting the time that it takes me to make this introduction. So we'll handle any questions or comments individually, and we'll do that by either telephone, email, Twitter, however you prefer to comment. I'll invite you to jot down any questions or comments you might have as we move along through this presentation. If the transmission is interrupted and you cannot restore by refreshing that tab, we'll try to furnish access to the webinar's replay. Just send me or send us an email. Otherwise, give us a call. Now, again, if you receive a very short survey request from Laura Donahue at this office afterwards, please know I'd greatly appreciate any and all of your comments and responses. We plan to continue to educate our clients and financial advisors and the investing public at large so that your survey comments will help us deliver the most useful content going forward. I want to begin this presentation with a story. I'm going to read from the book Why Smart People Make Big Money Mistakes by Gary Belsky and Thomas Gilovich. By the third day of their honeymoon in Las Vegas, the newlyweds had lost their $1,000 gambling allowance. That night in bed, the groom noticed a glowing object on the dresser. Upon closer inspection, he realized it was a $5 chip they'd saved as a souvenir. Strangely, the number 17 was flashing on the chip's face. Taking this as an omen, he donned his green bathrobe and rushed down to the roulette tables where he placed the $5 chip on the square marked 17. Sure enough, the ball hit 17, and the 35-to-1 bet paid $175. He let his winnings ride, and once again that little ball landed on 17, paying $6,125. And so it went until the lucky groom was about to wager $7.5 million. Unfortunately, the floor manager intervened, though, claiming the casino didn't have the money to pay should 17 hit again. Undaunted, the groom taxied to a Better Finance casino downtown. Once again, he bet it all on 17. Once again, it hit, paying more than $262 million. Ecstatic, he let his millions ride, only to lose it all when the ball fell on 18. Broke and dejected, the groom walked the several miles back to his hotel. "Where were you, honey?" asked his bride as he entered the room. "Aw, playing roulette." "Well, how'd you do?" "Not bad. I lost $5. This story, now known as the legend of the man in the green bathrobe, is known by casino pit bosses all over Vegas, but renowned by behavioral economists today because it deals with a bedrock principle called mental accounting. Because our newlywed started his evening with just $5, he felt his loss was limited to just that amount. This illusion of playing with the house's money plays as much a part in why casinos make so much money as the odds that favor them to begin with. Other illusions that innately work against the individual come from our cognitive biases as a result of our wiring, the neurology of our brains, and the predispositions we have to overreact or underreact to things like investing in the stock market, according to the studies in the field of behavioral economics. Here's some examples. Asymmetrical response to losing trades versus gaining trades. In other words, we react with twice the emotional intensity to losing trades as we do with winning trades. The disposition effect, where investors sell winning stocks too soon and hold the losers for far too long. Decision paralysis, and countless more behavioral-rooted inclinations that affect and impede our ability to remain rational about our own investment portfolios and the way we do our trading. See, the Living Portfolio is the title to our presentation, and that may seem like an odd title to you for a webinar on investing. But my hope for you is that by the end of this presentation, you'll come to appreciate that similar to anything else we rely on for sustenance, like a home, food, a job, personal relationships, we need to commit time, attention, and caring to our investments if they're to fulfill our expectations of them. Neglecting them has consequences. So too do emotion-based decisions when it comes to investing. A logical system can help you. So the goal of this presentation is to equip you with the awareness and know-how you need to begin using a system tomorrow that will help you address risk and invest more confidently. We'll begin to explore the logic of our systems-based approach by talking about things like investment risk. What is it? What is risk management? How do we manage investment risk? Why use risk management? Choosing who will do the investment risk management. And finally, a proactive plan, and in this particular case, our example is the DREAM system. So let's start today by examining investment risk and answer the following questions. What is investment risk? How does it threaten the outcome and how can we address risk? Let's start with that last bullet point. How can we address risk? Should we grin and bear it? That's also known as the buy and hold theory. How about avoiding it? But remember, no risk, no return. How about we insure it? Well, that comes with its costs and limitations as well. Why don't we adopt a plan to be adaptable to it? Does that sound interesting enough? Well, let's see how our industry defines investment risk. FINRA refers to investment risk to be synonymous with systematic risk, and they call that the risk from events that cause all stock prices to fall. They go on to point out that diversification among risk-on or growth asset classes alone does not work. They say the only real defense against systematic risk is to inlay certificates of deposit and some fixed return assets in the portfolio. Fixed return assets would be fixed yield, fixed maturity type of assets like bonds. And after 6,000 more words circumnavigating the subject of investment risk management, FINRA finally admits that modern portfolio theory, also known as the buy and hold strategy, is today's industry standard for dealing with investment risk. Which begs the question, does a one-size-fits-all approach seem like the right way to deal with each and every individual client's unique financial makeup? Well, there are a variety of risk categories that affect client portfolios. And I'm going to list a few that are quantifiable, and others are going to play themselves out in more uncertain ways. The first one we talked about in the beginning of this presentation, and those are cognitive biases. These are biases based on the baggage that we carry, the mental rules of thumb or the hopes for favorable expectations or disproportionate fears of unfavorable outcomes that shape our approach to investing. Another one is inflation risk. Inflation risk occurs when returns on certain investments, sometimes the entire portfolio itself, fall below the sustained rate of inflation. This causes what we call a negative real return, when the portfolio's purchasing power is diminished because the rate of inflation exceeds the rate of return on that portfolio. Another risk is timing risk, also known as point-in-time risk or sequence of return risk. Now, this is a risk that's inherent, that focuses on the likelihood of negative events occurring at the wrong time, like retirement or a black swan event. Black swan event, like let's use 2007 and 2008 as a recent example. Now, a black swan event is described as an event that deviates, an event whose outcome deviates beyond what is normally expected. It's not readily expected, and it's gone beyond the limits of expectation to the extent that they change our perception of reality, not just at the moment, but in many cases in future years following that experience. And that's what we call situational decisioning. That refers to how we change our outlook on investing or our risk tolerance. Thus, our decisions being based on last year's performance essentially says that we concede that emotion's going to win over the rational, logical approach to investing or money management. And finally, portfolio failure risk, also referred to as excess withdrawal risk, which is a risk that happens when perhaps retirees continue to draw a fixed amount of income out of their retirement nest eggs during periods of time when during periods of time of underperformance or even negative performance on those portfolios. See, without adjusting the amount of withdrawals downward to reflect the downward value of the portfolios, we might actually see a premature depletion of all the assets in that portfolio. In other words, the spending rate of that portfolio accelerates during periods of time of underperformance if the amount of money drawn out of those portfolios doesn't adjust accordingly. So we've identified a few forms of investment risk here. Let's now address how we're going to put a plan together to manage this risk. So let's look at a definition of risk for guidance here. Investopedia defines investment risk management as a process of identification, analysis, and acceptance or mitigation of uncertainty in investment decision making. So uncertainty seems to be the risk. It's the uncertainty of the outcome. Is the market going to go up or down? How long will it go up? How long will it stay down? To what degree will it move up or down? So breaking this definition down, we're going to identify and analyze the risk of uncertainty. And after that, we're going to consider whether to accept or mitigate that risk of uncertainty. And finally, by the end of this presentation, you're going to be able to put your own brand of investment risk management to work on your own portfolio, or if you're a financial advisor, your own book of business for your clients. Now, the next slides get us started on that identification and analysis of uncertainty. We're going to look at the magnitude of risk in terms of how bad can it get. And here is a study performed by Ned Davis Research, which takes us back over 84 years back to January of 1928. And what it does is it breaks the market corrections down into four main categories. I'm going to focus on the three main categories beginning from the right: the bear market, the severe correction, and moderate correction. What it shows us here is that for a severe correction of 15% or more, we see that it happens on average every other year. And it lasts generally over 6 months. And the average, or the mean decline in this case, was 28.2%. A bear market, or a 20% or more correction, has happened over that period of time every third year. Lasts approximately 10 months, and the mean decline during that period is 36%. We can also see that the duration of that period of 10 months and 36% could severely impact our portfolio or impact our future if we were going to become retired in the next year or two. So how does this affect us? And why is this so important? Well, we can use these as just these historical averages just to give us perspective. But and the perspective that we'll talk about is how much return needs to follow those periods of loss in order to break even. In other words, a calculation of a 20% account value drop would require us to earn 25% positive return before we ever got the portfolio back to break even. A 25% drop in the value of the portfolio would require a 33.33% return before we ever got to break even. And this is the calculation that I use to figure these numbers. So we're looking at not just a period of time that it takes to get out of these holes, but we're also looking at the degree to which we need positive performance immediately following that downdraft or that depreciation in the portfolio to get back to not to square one, but to where we were before we hit that pothole. Now let's take a look at a real-life situation in the calendar past where we view an actual decade of investment performance to see how magnitude and timing of returns as well as the recovery percentages come into play. Imagine, if you will, a couple. retiring on January 1st, 2001. And in their investment portfolio, they focused on their equity holdings and agreed with their financial advisors on the expectation of a 7% annualized average return over the life of that portfolio. If that were $100,000, that 7% annual compounded return after 10 years would grow to over $196,700, so an increase of $96,700. The real result? Well, there's good news and there's bad news here. The good news is that over those first 10 years, we saw up years in seven of those years. And the bad news is that although there were just 3 down years, the severity of those down years and the timing of the down years were such that it impeded the portfolio's return. You see, the portfolio didn't grow by 7% annualized compounded rate of return. Instead, it was up about 1.56%. The portfolio didn't grow to $196,700. It only grew to $116,729. A major shortfall in this particular case by $80,000 or 80% of the portfolio over that period of time. To add injury to insult, if they had just invested in money market instruments, the portfolio would have likely grown to $123,000, more than what they got out of their equity investments. So suffice to say, there's not a whole lot of life. This doesn't look like a portfolio that was extremely vibrant or lifelike during that entire decade. So let's come back to that question. Knowing what we know now about the timings, the severity, the length of time, and the outcome or the impact on return, should we choose? Is it such an important process? Is this a big enough factor that we should begin to consider mitigating risk? Could we come up with a plan, in other words, to avoid this from happening? Do you at least have a contingency plan for when things break down? Here's a serious question. Let's address how we should approach building this plan to manage investment risk. So let's begin by establishing a few absolutes as guiding principles. The first one is proactive management is better than reactive. That's a good place to start, and that statement speaks for itself. The second one is responsibility is not limited to the investment manager. Well, who is the investment manager? If we're a do-it-yourselfer, we are. The owner of the account is the investment manager. That's pretty straightforward. But if there's an intermediary, if there's a financial advisor, there may also be a mutual fund manager, or there may be a separately managed account manager. There could be 2, 3, or 4 different parties who might pick up some of the slack in terms of managing the investment risk. Point to be made here is make it very, very clear who's going to manage risk and what the parameters of managing that risk should be. And finally, if you can't assess the risk of an investment, you probably shouldn't own it. Put a different way, if you can't assess the risk of an investment, you're not an investor, you're a speculator to that degree. And maybe you should think about diversifying down the size of that investment so that any adverse movement in that particular speculative investment doesn't draw down the value of the rest of the portfolio by all that much. And finally, at Baring Financial, we believe that risk management framework should be aligned with client objectives, expectations, and investment horizons. In other words, the investment management plan should reflect each client's own particular circumstances. So we built our framework on a proactive, quantifiable, and systematic system. We call it the DREAM system, and here's how it works. These are the names of a number of different indicators, technical indicators that might come into play from time to time. Our model downloads market data every night. More than 36 market data elements fed into 9 key indicators. 3 of them are long-term indicators, 3 are middle-term indicators, and 3 are short-term indicators. Based on the nightly updates, our 9 key DREAM indicators are coded according to their risk classifications. Based on these classifications, the model then complies or prescribes rules to us that limits the extent to which we will have our clients exposed to that market risk. There'll be 4 different levels: full offense, full defense, and 2 points in between. Full offense is 100% of the client's specific maximum equity exposure. Full defense is 25% of the client's specific maximum equity exposure. The other 2 readings are 75% and 50%. Now, for the sake of today's discussion, I just want to focus on one of the DREAM system indicators as an example of how this can work for us. We're going to focus on bullish percent, and this refers to the percent of stocks within a given universe that are on buy signals. So, for example, of the 500 stocks in the S&P 500 index, if 450 are on buy signals, the bullish percent for S&P 500 stocks would be 90%. That would mean 10% are on sell signals, 90% are on buy signals. Now, we use the bullish percent for a couple of things. Number one is it's a good measurement of risk, okay? And it's also by applying a trend chart methodology to it, we can measure and actually visualize the competition of the competing forces of supply and demand for stocks on a day-by-day basis. So we're going to look at a trend chart to see how that works. We're going to use the bullish percent for New York Stock Exchange stocks, which is a population of over 2,500 stocks, to see how it's tracked. Now, the vertical hash marks on this point and figure chart indicate the year 2008, 2009, 2007, and 2010. The values on the far left-hand side are the percentages of these bullish percent for New York Stock Exchange stocks. X's move up, show upward movement. O's move down. X's show demand increasing over supply. O's show supply increasing over demand. The numbers 1 through 9 depict months January through September, and ABC is October through December. Here we see, for example, in February, the number 2, February of 2007, that 74% of the stocks of the New York Stock Exchange were giving buy signals, and 72% in April of 2007 were giving buy signals. Down here I've highlighted the X, which happens to be October of 2007, when 62% of the stocks in the New York Stock Exchange were giving buy signals. As we can see here, we see a long drop. And at this point in time, we begin to get concerned when the percentage of stocks giving buy signals drops by such a magnitude. This would have been a first cautionary signal for us if this was the only index we were watching. We see that it dropped some more through the beginning of 2008. So we see all the way down to October of 2008, where only 4% of the stocks in the New York Stock Exchange were giving buy signals, or 96% were giving sell signals. Many of us remember that time in October. In fact, what happened in October of 2007 here, we were at 1562, the S&P 500 was, whereas October of 2008, the market dropped to 840. So that bullish percent was telling us something. That was the market dropped by more than 45% at that period of time. The bullish percents could have indicated for us a worthy signal for getting out of the market. By March of 2009, bullish percent we see actually gathering steam by putting in some higher bottoms. 14%. It more than tripled in March 2009. But the S&P 500 dropped more. It dropped another 10%. So during a period of time when we actually saw the bullish percent gathering steam, the market headlines were focused on the values moving downward. The dream system was picking up this signal. And by March of 2009, the dream system told us to double our equity exposure. By July of 2009, we were brought up to another level, and the dream system put us at full offense by September of 2009. In reality, there were people running for the exits at a point in time when the dream system was telling us it was time to push money back into the market. Now remember, the bullish percent is just one component. It's a medium-term indicator within the dream system, but it combines with 8 other indicators to help the dream system determine the levels of offense or defense we should be at. In this case, even though the bullish percent was rising, investors were bolting for the doors. We chose to do otherwise. So this is just, again, an example and an illustration of how one indicator within the dream system works. The question here is, will you make that choice to decide on whether to mitigate or deal with risk in a changing, dynamic market in a logical way that can keep your portfolio alive? Or will you choose not to decide? You see, choosing not to decide is a decision in and of itself. Our plan is the dream system. That's what we choose to use. No system's perfect. The dream system isn't right all the time, but when it is, it corrects itself to get us back on the right track. It's not about market timing. It's not predictive. It's trend-following system. It measures the risk levels in the equity markets, and it recommends corresponding limits on our exposure to that risk. It's not based on emotion. It's based on evidence. Now, we talked about the risk and the analysis of the uncertainty. Now we're pivoting on the decision whether to or not to take steps to mitigate that risk. I promised you the third step would be one where I'd help you make yourself ready to put the dream system to use in your portfolio or your book of business if you're a financial advisor. So let's see how that might work. This is a view of the principles of the dream system and how it works. This shows the 4 different levels of the dream system: full offensive, what we call bull cycle; full defense, which is a bear cycle; and 2 points in between. We rank our clients on a scale of 1 to 10, a 10 being an equity cap of 100%. In this particular case, we're seeing TMA, which stands for Tactically Managed Account. And we see the corresponding limits at these levels for the TMA 5 investor versus the TMA 8 versus the TMA 10 investor. When the dream system gives us the signal, the TMA 9 investor will drop from 100% offense to 75% offense. In this case, means that from 90% equity, he'll go to 67.5% equity. The 50%, or the TMA 5 investor, the 50% equity investor will go from 50% to 37.5%. We'll drop another corresponding 25%. And that's how the principle works. I wanted to show this graph so that you could, if you're a financial advisor and you have a broader book of business, you might think about it in terms of how it might be adaptable to your practice. If you're just looking at it as a do-it-yourself investor, this would give you a graphic example of how it would apply to your portfolio. Now, for our clients, we take 4 simple steps, and actually an optional 5th one. But for the benefit of the financial advisors on the phone, the first on the webinar, the first thing we'll do is we'll determine risk tolerance. Matter of filling out a questionnaire, having a long conversation with our clients to determine their knowledge, their history, their background, their expectations, and we'll come up with a number from 1 to 10. The second thing we'll do is we'll establish their maximum risk level. That is their TMA code. That's that number, 1 to 10. And we'll apply those. We'll begin to distribute their investments into a diversified portfolio of tactically managed asset classes. The third step is merely a statement of, or an option of, whether or not the client wants to have a risk management overlay. That's a yes or no answer. And the fourth step is we actively manage the equity levels according to the DREAM updates, which are fed by Twitter feeds or my tweets that the DREAM system puts out. Or if you don't have a Twitter account, you can just monitor those tweets on the Baring Financial Advisors home website page. Those tweets generally will give us not only what the DREAM level is, but they'll also give us a data point or a piece of information that is in line with substantiating why the DREAM system is at that level. The DREAM system changes only when the risk levels change. And in 2014, it's only changed 3 times so far this year. In 2013, it changed once in January from 75% offense to full offense, and it kept us at full offense for the entire year, 2013. 2012, however, was a very choppy market, and that changed 12 times. So it really is a variable that's based on the performance in the marketplace. Again, our inspiration here is to protect from market decline, severe market decline. Now, so I want to tell you again that this picture here is intended for you to envision how you might manage the portfolio, or how you might manage your book of business, or certain portions of your investment business. There are lots of ways that the DREAM system can be used. One of them is, as I referred to passively, by including it in the client investment policy statement. Again, clients may opt out of active risk management, in which case that's just fine. We use the DREAM system to guide us through our 401k allocation and rebalancing recommendations for our clients. We also use it on a regularly scheduled basis for adjusting annuity allocations and rebalancing across sub-accounts, especially where there are not those guaranteed living benefits in those. It pops up invariably in every new client opportunity when we have a prospect in our office who begins to focus on investments. Eventually asks us that question that we know is going to pop up: what are you going to do if the market craters? Our standard answer is we use the DREAM system. It's a system that systematically measures the changing risk levels in the equity markets and prescribes the extent to which we'll be exposed to it. When it tells us to increase exposure, we will. When it tells us to play defense, we'll do that as well. It helps us to also rationalize the way we're going to add new investment dollars to existing accounts and contracts. We've applied it systematically across a number of different brokerage account platforms so that logistically it can help us and enable us to apply that risk management evenly across account base, regardless of size and asset classes. There are a number of different ways that an independent, unitary risk management tool can be adapted to make you a better investor, to help you manage your investment book better. I want to say that based on your individual needs or your investing system, we can examine that and explore that for you. See, Since 2007, our mission's been to save our clients, our friends, and our family from financial ruin by keeping their investment portfolios alive and keeping them thriving. If you have any questions about how the Dream System can help you, I'm happy to discuss our experiences with our approach. You can contact me directly by phone. You can email me. You can follow the Dream System tweets on Twitter, or you can follow them on the Baring Financial Home website. You can follow my commentary on Twitter as well, as Scott Bussey. And most of all, I want to thank you today for being a part of this webinar. We thank you for participating. Let me know what I can do to help. In the meantime, don't fear the market, and have a very awesome day.